Is Albertsons a buy at 20.50 per share? And if you want to build indestructible generational wealth, is Albertsons a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis on Albertsons based on their recently reported 1Q25 results. Trading at 20.50 per share, I currently have a hold rating on Albertsons stock. In my research, I discovered 7 things that got me very excited and 6 red flags to watch out for with Albertsons. So what did I discover? What's my value for Albertsons stock? And what's an ideal entry point should you decide to become an Albertsons shareholder? I'm Ken Freeman. I have 20 years of Wall Street experience in investment banking and hedge funds, and I train analysts at the top banks on Wall Street. In this video, I will cover Albertsons' recent results and what everyone is missing, what I think about Albertsons stock and what my analysis uncovered, what Wall Street's smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. If you're enjoying this, please smash that like button. While Albertsons' revenue and adjusted EPS for the quarter beat analyst expectations, their management of upcoming tariffs and continued litigation regarding the failed merger with Kroger continue to weigh on the stock. Let's cover the red flags first. Albertsons just told vendors it won't swallow tariff-driven markups. If suppliers can't raise prices, some may walk, risking shelf gaps and tougher negotiations.
Our first line of defense, though, is to push back with our vendor partners, deconstruct the cost increase, and make sure that we're all in alignment of the rationale behind it.
The merger drama isn't over. Kroger just fired back with its own lawsuit. $19 million of merger-related costs in Q1 had a direct impact on the bottom line. Years of legal fees and headline risk are still on the menu. Remember, regulators already targeted the Kroger deal as anti-competitive. That cloud hangs over any future M&A hopes for Albertsons. Management's new fiscal year 2025 EPS outlook of 203 to 216 was the same as previous guidance, and the stock slipped. Albertsons' gross margin fell to 27.1%, continuing a downward trend. Compressing margins are especially hard to swallow with the unknown impact of tariffs still lurking.
To drive this growth, our gross margin rate of 27.1% was lower than last year by 85 basis points, excluding fuel and LIFO expense. Incremental investments in our customer value proposition and the mixed shift impact related to the strong growth in our pharmacy and digital businesses drove this decrease, but was partially offset by benefits driven by our productivity initiatives, including improved shrink expense.
Net debt, which is debt less cash, sits at $7.69 billion, which is 1.96 times EBITDA versus 1.81 times EBITDA a year ago. Higher leverage reduces flexibility if the economy slows.
At the end of the first quarter, our net debt to adjusted EBITDA ratio was 1.96.
This is what everyone is missing. The Q1 release sparked an intraday drop of over 5%, and this is a stock that already trades at a discount to its peers. For a company that beat expectations on revenue and adjusted EPS, this feels more like a buying opportunity than bad news.
I'll just get my groceries.
Stay tuned because I'll give my ideal entry point for Albertsons later in the video. Here's what got me really excited. People are buying more. Total sales rose 2.5% to almost $25 billion. Even stores open more than a year rang up 2.8% higher sales. Growth during high food inflation shows Albertsons can keep shoppers coming.
In the first quarter, our teams delivered solid results with ID sales growth of 2.8%.
Drive Up and Go, Instacart, and DoorDash are working. Digital sales leaped 25% year over year. Online growth protects the company if in-store traffic ever slows.
Our first digital platform is e-commerce, which grew 25% and reached 9% of total grocery revenue in the first quarter. This growth was again led by strong performance in our first-party business, driven by award-winning capabilities in our fully integrated mobile app and supported by our 5-star certification program.
The Just For You app keeps expanding. 47.3 million customers are logged in.
A lot of people.
More members means more coupons, bigger baskets, and better data for future pricing.
Our second digital platform is Loyalty, which grew 14% to 47 million members in the first quarter as we capitalized on the simplification of our program and further enhanced the value the program offers.
Management raised this year's same-store sales goal to 2% to 2.75% over previous guidance of 1.5 to 2.5%. Increasing guidance shows that the grocery giant still sees steady demand ahead, even with tariffs and wage pressure. Prescriptions drove the biggest piece of same-store sales growth, and it's recurring revenue. Pharmacy margins are fatter than grocery margins, which is good news for earnings.
Our third digital platform is Pharmacy and Health, which grew 20% year over year, driven by industry-leading script and immunization growth, best-in-class customer satisfaction scores, and the ongoing integration of Pharmacy and Sincerely Health into our overall digital experience.
Capital spending funded 36 modern makeovers and 3 brand new locations last quarter. Updated, brighter stores can lift traffic and increase sales,
including the opening of 3 new stores and the completion of 36 remodels, as well as the ongoing modernization of our digital and technology capabilities.
In one quarter, Albertsons bought back $315 million in stock and kept its 15-cent dividend, about a 3% yield. Big cash returns show plenty of cash for shareholders, even after store remodels.
We also returned $401 million to our shareholders, including $86 million in quarterly dividends and $315 million in share repurchases, leaving approximately $1.5 billion in our existing multi-year $2 billion share repurchase authorization.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
How about no?
That is exactly what you're doing when you buy a stock without understanding the company's 3 financial statements. If you want to see how I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. At the end of 2024, Albertsons had only 10% of the level of cash that it had 3 years ago in 2021. Albertsons paid a $4 billion special dividend as part of the Kroger merger in 4Q22, so they stockpiled cash, which means that one was kind of more of a head fake. We're going to see this later on when we cover the cash flow statement. The company has done an amazing job managing its operating working capital, which consists of receivables, inventory, and accounts payable. This is quantified by a metric known as the cash conversion cycle, which measures how long it takes to get inventory, sell them, collect cash, and pay suppliers. We want this to be as low as possible so we get cash faster. From COVID prior, it was about 2 weeks, and now it's been slashed in half to only 1 week. While debt of $7.8 billion might seem high, it has been steady and consistently declining over the last 8 years. Albertsons was taken private in a leveraged buyout nearly 2 decades ago, which saddled them with debt. But the private equity firm that bought them is still a major investor, which I'll cover later in the video, so stay tuned. So what's the takeaway? While the company has close to $8 billion in debt, it is steadily declining, the business is very stable and efficiently managed, which is especially important in the grocery business. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Top-line revenue growth has achieved a 5.2% rate over the last 5 years, while net income has increased more than 3x that rate to 15.5% over the same 5 years. Remember, revenue is what you make, net income is what you keep. So this is indicative of a very efficiently run business with massive operating leverage. Post-COVID, all margins have been declining, from gross margin all the way down to net margin. Groceries is a tough business, and with food inflation, stiff competition, and looming tariffs, cost control is an absolute must. As mentioned earlier, the merger with Kroger failed, and the company wasted 2 years to get the deal done. To add insult to injury, Kroger has refused to pay a $600 million termination fee, which is worth $107 per share to shareholders. And Albertsons keeps spending legal fees to get its termination fee and settle claims from the failed merger. The sooner the company can put this all behind us, the better off we all will be, and less money will be squandered. So what's the takeaway? While growing revenues and positive operating leverage indicate a very well-run business, moving on from the divorce with Kroger's is critical for the company and its shareholders. The cash flow statement tells us where the cash is generated by the company, and there are three buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. While free cash flow has more than doubled over the last 6 years, it has been very lumpy. This is mainly due to COVID in 2020 and 2021, but without the merger distraction, it would be even better. Capital expenditures are budgeted as a percentage of revenues, a measure known as CapEx intensity. Albertsons has only a 0.5% difference from its low to its high, which shows incredible discipline. While shareholders were rewarded with nearly $2 billion of buybacks thanks to COVID, the failed merger with Kroger put the brakes on for the next 3 years. Fortunately, the board approved a $2 billion share repurchase program, and they repurchased $315 million in Q1 with more to come. Since this is not a rapid growth technology company, more return will come via dividends. Since 2020, gross dividends paid have more than tripled over the last 4 years. And this past quarter, the company announced a per share increase of 25%, going from 12 to 15 cents per share per quarter. At the current close price, taking the annual dividend over the price, that's almost a 3% yield. So what's the takeaway? Growing free cash flow, disciplined capital expenditures, and returning capital to shareholders, all things that investors love to see. So what do I think about Albertsons and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to build financial models just like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of about $13.1 billion. We divide by the current shares outstanding, we get an implied share price of $23.39. Compared to the current close of $20.57, that's a 13.7% discount, which is a solid hold rating. On Wall Street, if a stock is trading at greater than 20% discount, it's considered a buy because it provides us with a margin of safety. I'll give you my thoughts on how to play Albertsons stock later in the video. So what does Wall Street have to say about Albertsons? Let's cover that next. The consensus among analysts is positive, and Wall Street sees limited downside with margins stabilizing and the positivity around new CEO Susan Morris. Evercore has a hold rating with a price target of $23. Evercore maintains a neutral stance. They trim margin expectations but see limited downside. Roth Capital has increased its price target for Albertsons from 23 to 24 while maintaining a buy rating on the stock. Roth lifted its target after Q1 sales and EPS topped estimates, and they expect unit volume recovery ahead. BMO upgraded the stock to outperform and set a $25 target price. BMO upgraded on attractive valuation and stabilizing earnings margins after the CEO change. CapIQ shows me how other analysts on Wall Street view the company. 19 analysts cover Albertsons on Wall Street. The target price ranges from a low of 19, which is an 8% decrease, to a high of 29, which is a 41% increase. Upside outweighs downside by over 5 times, 41 to 8. Hedge funds typically look for 2 times and greater, and here we have 5 times, which is absolutely exceptional. The median is $25, which is a 22% increase. The overall rating on a scale of 1 to 5 is 2.09, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do have a position in Albertsons. It is the 8th largest holding in my portfolio with a weight of 5.3%. I bought Albertsons well before the merger with Kroger and held it hoping that the deal would go through, which it didn't.
Well, we sure saw that coming.
But I see solid upside and it's at a nice discount. Also, I'm getting almost a 3% dividend yield while I wait. If you decide to buy Albertsons, I'll tell you exactly how to build a position, including the ideal entry point, which I'll reveal shortly. New boss Susan Morris started stocking shelves at Albertsons in the 1980s and worked her way up. 4 decades on the front lines give her deep insight into what really moves sales and morale. Imagine you were able to take the reins of the company you've worked for your entire life. That's why I'm bullish on the new CEO.
Albertsons Executive Vice President and Chief Operations Officer Susan Morris will take over effective May 1st of this year. The company says that the two will work together until that time to make the transition as smooth as possible. Morris has been in the industry for nearly 40 years and started her retail career at an Albertsons location in Denver.
The company's B2B grocery website now serves over 2,000 stores, selling office snacks and bulk orders. This is a high-margin, fresh revenue stream beyond traditional shoppers. Private equity giant Cerberus owns 26% of the outstanding shares of Albertsons, and they will strongly influence the company's decisions. Cerberus has been around for over 30 years, and they have $65 billion of assets under management. At a market cap of $11.6 billion, that means Cerberus owns over $3 billion of Albertsons stock, and it makes up nearly 5% of its overall portfolio. Having a private equity investor advocating for us as shareholders with their financial expertise is a tremendous positive. Albertsons hit a 52-week high of $23.20 in early April of 2025, and it's down over 11% since then. Albertsons hit a 52-week low of $17 in early December 2024 when the merger with Kroger's was terminated, and it's up 21% since. My model shows a value of $23.39, which is a 13.7% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Albertsons is a solid hold at current levels. To get it at a 20% discount, the ideal buy-in price is below $19.50. If you decide to add Albertsons to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position. Once Albertsons is able to move completely on from the failed merger with Kroger's, the lid will be taken off the stock and it will have room to run. If you like this and want to see another in-depth stock valuation, check out my Apple video here or my Rivian video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.